You've worked hard to build a dream retirement. Now it's time to put that plan into action. This is Retire ATL with Aaron Vincent and Matt Decker. The team at Vincent Financial wants to help you build, protect, and grow income to get you to and through retirement. Now, Retire ATL with Aaron Vincent and Matt Decker.
This is the Retire ATL podcast, all powered by the Vincent Financial Group. You can get more when you visit retireatlradio.com. Thanks for subscribing. Thanks for downloading. Now, let's get to the show. We are here with CFP and investment advisor Aaron Vincent, alongside CFP Matthew Decker, helping you retire on your terms. We talk about it every week. The three key pillars: tax planning, risk management, and determining your income strategies. It's all about you. retireatlradio.com. All right, I want you to hear this clip, and it's a new buzzword going around. Many call the record highs on Wall Street a market melt up.
Oh.
Never heard this before.
Does that come with cheese?
Right. Investopedia defines it as rising stock prices driven by investors following the opinions of others rather than fundamentals. I want you to hear this clip from portfolio manager Scott Zelnicker, who tells Fox Business this melt up is far from over.
I've been doing this for 34 years. I've never seen a backdrop as strong as what we're looking at right now. We have the technology revolution, and we've entered a new chapter with AI. The second component is the Fed. We are now in the era of don't fight the Fed. And then the third is the roaring 20 setup we have. Deregulation, lower taxes, and improved productivity. Do you know since 1980, the Fed has cut rates 20 times with the markets within 2% of all-time highs. 20 times out of 20, the market was higher a year later.
Two-part question: what is a melt up? And number two, could a melt up lead to a market meltdown?
I think it comes with a combo, like a drink and a fries.
It's on rye.
Yeah, it's $2.99. You get both the melt up and the fries and a drink.
Go on. What if I want to supersize that melt up?
All I know is whatever he's selling, I'm buying. You know, he used all those big fancy words.
Yeah.
19 roaring 20s. We never had a drawback like this.
I guarantee his next sentence was, and I've got gold to sell to you right now.
Let's talk
a melt up can only mean like that there's some kind of, he's implying some kind of like artificial growth happening in the markets, and you're getting lullabied into sleep by your account balance increasing with the stock market. Meanwhile, the giant bomb's about to drop behind the scenes.
A meltdown would be what, like panic? Falling, panic,
like
everybody's faces are melting, and it's like destruction. And so a melt up would be, it's just going in the opposite direction, and everyone's just, what he said, kind of jumping on the bandwagon and just following each other. Or was that Investopedia? Investopedia said they follow the opinions of others rather than fundamentals. That sounds like every day.
That sounds like news and media.
That sounds like Monday.
Right.
Let me just do what my golf buddies are doing. Right?
Yeah,
I mean, isn't that what's always happening?
This is like a classic case of like, try to make something not new at all sound new by saying things like, I've never seen a backdrop as strong as the one we're seeing. What's a backdrop? Define that one for me.
Isn't that green screen that like puts everything else out of the picture, and then you can, it's also interesting that, you know, no one wants to talk about how much money we've printed over the last like 15 years. If money has basically been free for a decade, and we've printed trillions of dollars of money, the money supply, the amount of money in circulation has exploded. Where does that money go? It isn't going into just like your savings account. It's going into things like real estate. It's going into the market. Like that money is being spent. So, of course, the market is at all-time highs. The money supply is at all-time highs. But no one wants to have that conversation. No one wants to have that conversation. I don't even know that I want to have that conversation. It's a hard conversation to have. It's not as easy as a 30-second soundbite that you play on MSNBC.
Right.
Could it lead to a meltdown is the question? I think, yes, it could. Now, define meltdown. Does that just mean that the market corrects? Well, is that a meltdown? I don't really, I would call it a meltdown because it's the normal cycle of things. Like, to your point, Matt, the artificial buildup of stuff happening from printing money and et cetera, et cetera. Yes, will that be corrected, and will things fall to a more realistic kind of a market, yeah, it will happen. And I'm not scared of that. Our clients aren't scared of it. And this is what we're constantly talking about, how like majoring in minors and somehow finding a way to make the not so important thing the important thing. Mm-hmm. We got to get off that train.
Are you about to talk about a durable portfolio?
Oh, you know I am. You know.
Gosh, I was so looking forward to hearing you just say the word durable.
Look, I'm an investment advisor. We invest people's money for a living. That's at least one major part of what we do. And performance is critical. It's important. All right. Let's not miss out on we are really proud of the portfolios that we build. Our clients are happy with them.
Come on, say the word.
Here's the deal. I'm actually not that interested or concerned with building you a portfolio that gets you real sexy returns.
Yeah, say it.
I'm just not. Now, you might say, you just said you're my investment advisor and performance matters, and that's true. But here's what I am after. I want to build for you a durable portfolio. What does durable mean? It means that in times of melt-ups and meltdowns and every melting in between, you can stick to your portfolio, because if you can stick to the plan in the ups and the downs, if you can stay the course, then you will get those sexy returns. You are primed to reap the benefit, and you are going to be one of the ones who benefits from everybody else freaking out. That is the way this thing works. Now, if you're afraid and you're freaking out of that potential meltdown from the backdrop and the whatever else we're talking about.
The 1920s depression setup.
Stuff. Yeah. If you're freaking out and you're like, your ears perk at that and you're got your finger on the trigger to move me to cash before that happens. If that's the game you're playing, your losses are going to line the pockets of our clients.
That doesn't sound very durable.
That's not a durable portfolio. Now, a durable portfolio is one that you can stick to. That's what we build, meaning that ups and downs and in-betweens, you can stay the course because you know the other side of a melt-up or a meltdown. You've seen it because we've stress tested it for you, and you can stay the course.
Well, hold on,
You'll
Aaron.
reap the benefits.
People need to know that this is easy to quantify. Like, we can easily have this conversation. Do you have a durable portfolio, or do you have a paper-thin portfolio where you need to have your finger on the button? This is easy to know. All you have to do is go to retireatlradio.com. We've revamped the whole homepage. It's super simple. At the very top, you'll see schedule a 30-minute consultation. We will talk to you about this very topic. It's crucial. You need to have this conversation with someone. If it's not with us, find someone that you trust. Have this conversation. You need a durable portfolio. But Aaron, I am curious. We talking about melt-up? We talking about melt-up?
Yes, we are.
And we talking about meltdown. How do you make sure that your portfolio is durable? Like, what are the mechanics of a durable portfolio? I know the answer, but I'm curious how you would phrase it. I have a phrase
that answer, Matt?
I think so.
I want to hear your phrase.
You want to hear my phrase?
I really do.
Okay. I've been stewing on this for a little while. I've never said this on the air. I've never said this to Aaron. But what I'm starting to
be
feel
here for this moment, by the way.
What I'm starting to feel, the words that are coming to me is,
I'm closing my eyes.
A durable portfolio has polarity. And what I mean by that is, you don't have one thing that's trying to do all the things well. You have polarity. Your portfolio is not trying to be one thing that's doing everything well. You have growth money, and your growth money's goal is to grow. So let's make this easy, because there are things that we can say on the radio, and there are things we can't say because it sounds like advice, right? And we got to be careful the words that we use. So when I'm talking about polarity, let's imagine two types of investments on the opposite side of the spectrum. On the one side, you have your growth dollars. Your growth dollars are not cash in the bank, right? Your growth dollars are wildly volatile. It's up and it's down. Its goal is to grow. On the other side, the opposite of your growth money is your money that's like, let's just say it's cash, right? It's not going up and down with the markets.
Down is the enemy in that case.
Whether you have a melt up or a melt down, you have a portion of your dollars that are going to benefit in each of those different environments. In the melt up, you have growth money, and it's participating in the market, and it is just kicking and taking names. Like, it's killing it for you, and that's great. But you don't want all of your money in a growth bucket during a meltdown. And so you have some money that's on the other side of the spectrum. You have polarity. You have your growth money, and you have money that is not subject to the whims of the market, that is going to do what it needs to do no matter what happens in the market. So that if you're experiencing a meltdown, you know that not all of your money is riding that wave. And that, to me, would be a very durable portfolio.
Yeah. Here's what we find almost daily in our office. Very, very common. I would kind of argue that maybe 7 of the last 10 portfolio reviews that we did, people thought they had a durable portfolio. Why? Because they've got a lot of funds. They can look at their portfolio and see a long list of what's in there.
A lot of ticker symbols.
Maybe you got a 401k, you're looking at that statement. Maybe you've got a big box kind of financial planning investment firm and you got that statement. Whatever statement you're looking at, you look at it and say, wow, there's like 20, 30, 40 different assets in here, ticker symbols, if you will. So I must have a durable portfolio. There's no way that we're kind of overweight and swinging for the fences, right? Because there's a big list here.
I got some diversification.
Exactly. What we often find is there are absolute landmines in there that you can't even see. I'll give you an example of just recent stuff. So if you've done any research at all or listened to any news in the finances, you've heard the term the Magnificent Seven in talking about stocks. All right. We're not going to get into all those details and what they are and all that.
That's like an old samurai movie, right?
Yeah, that's it. But we're talking about the Magnificent Seven stocks.
Oh, okay. Thank you.
All right. So in the S&P 500, in order to not get the precise numbers wrong, I'm not going to say the exact stats I heard because I'll probably misquote it, but a large percentage of the S&P 500's growth recently is from 7 stocks, the Magnificent Seven. And remind you, there are 500 stocks in there. So it's very possible, this is what we see all the time, that you've seen some good returns in your portfolio over the past year or 2 years or 3 years. It's possible that you're like, hey, this is actually going pretty well. This must be a good portfolio I'm looking at because I've got good returns. And that's one way of looking at it, and I'm glad you have good returns. But if you're so overweight those 7 stocks, which if you haven't looked at it with
what do you mean by overweight?
Meaning like you've got way more than you realized of those 7 stocks. An example would be you're looking at your list of investments in your portfolio. It's a lot of mutual funds or a lot of funds. Well, more often than not, all of those funds own a lot of the same stuff. So if you have 15 different mutual funds in your portfolio, solid chance that 10 of those own the same Magnificent Seven 10 different times, right? So that's just a phenomenon that happens all the time. Now, when things are good, i.e. where we are right now, where we have been for a while, you're seeing positive growth. You're thinking, I've got a great portfolio. It's growing. All of a sudden, when there's a meltdown going on, and you're like, holy smokes, I did not expect to lose that much. Now I'm in trouble. How did that happen? It was going so well.
I was diversified.
I had I was so diversified. I had
so many ticker symbols.
So many funds in there. How could it be? That's an example of not a durable portfolio. That's an example of this thing called drift happening where we kind of got lullabied to everything's so good. I'm seeing double-digit returns year over year over year. How can anything be broken? Let's just let this thing ride until it doesn't. And now the consequences may be too much.
You just said drift. What's drift?
So a phenomenon in the world of investing is, Matt, let's imagine that you've got 60% equities, so stock market driven investments in your portfolio, and you've got 40% non-equity.
I got my standard 60-40 model.
Yeah,
got it.
Your 40%'s in like bonds and money markets and government securities and just stuff like that, not stock market stuff. All right, well, if you just let that thing sit and let it grow.
Which I'm supposed to, right?
You're supposed to do. Okay. Hey, don't worry, it's all going to work out.
Yeah.
It always comes back. Just let it ride.
I believe you.
Okay. If that's the case for you, what's going to grow more? This is a rhetorical question I want you to answer.
Well, I hope my stocks grow more.
Yes.
That's what they're supposed to do.
Yeah. Your 60% side of your portfolio is going to grow more than your 40% side, correct?
Right. So and I'm doing nothing. I'm listening to you, and I'm just like hands off the wheel.
Letting it ride. Yeah. So let's say we let that go for 6 months. Let alone 6 years. We've talked to folks in our office recently who haven't talked to their advisor in many years. But let's just use a 6-month example.
Yeah.
And it's a pretty good 6 months in the market. Well, just by definition of what just happened, your portfolio drifted from a 60-40 with you doing nothing, making no changes, adding no new money, etc. Your portfolio, as it was just going along, became a 70-30.
Because my growth money, my equity money grew faster than my bond supposed to be, less risky side of the equation.
Correct.
And so now my 60-40 portfolio, because of the drift and growth of one side versus the other side,
just the ratio of what's in there, the ratio is bigger.
Actually a 60-40 anymore.
Correct. Now,
that's drift.
That can happen very quickly, and the longer you wait to make adjustments, It can happen in significant. I mean, we've seen them so far out of whack, people like jaw drop, like I had no idea.
So you start with a 50-50 mix. I'm going to be extra conservative. I don't want a 60-40. I want a 50-50, even less risky.
Right.
And then you have that day in the market where you're like, I didn't realize I could lose that much money in one day. It's because you don't have a 50-50 anymore, more than likely. Your risky dollars, your growth dollars have grown faster than your less risky dollars, the portion of the money that's not supposed to be so high growth. And now you don't have a 50-50, you have a 70-30, or you have an 80-20. And maybe you have a 70-30 portfolio where of the 70%, the majority of your 70% is contained in seven stocks.
Right.
And so you have a risky 70-30 portfolio. And that's how you can lose all that money in one day. And that is portfolio drift.
And that's an enemy. And that's something that you have to have your eye on. And that's why these kind of conversations and just you knowing what's actually happening. Just do you know the makeup of your portfolio and the rationale and logic to why it is that way? And does that rationale logic fit your situation, your life, your future goals? If you can't quickly say yes to those things, you have got to take us up on our offer. And you can do it real easily. RetireATLradio.com. Top of the page right there, there's a button you click to simply schedule a 30-minute call with us. It's that easy.
Again, retireatlradio.com. From the homepage, you can schedule that appointment. You can meet the team, put faces to the voices that you hear. You can also check out the Retire ATL podcast, this weekend show, plus a full archive, all commercial free. Find all this plus a lot more at retireatlradio.com. It's all powered by the Vincent Financial Group. So we were talking about growth in a portfolio, 60-40, but now let's talk about how to be a little less risky, if you will, in our portfolios.
On that safer side of the equation.
Right. So it's like the melt,
right,
but it doesn't have as many calories.
Right. It doesn't have the onions in it.
Exactly.
Yeah.
Not trying to burn it.
It's more mild.
Yeah, exactly. A little bit, yeah.
All right. I love that.
Better for you. Wheat bread.
It's funny. We have a bunch of people that come into the office and, they have these traditional like 50-50, 60-40, your stock getting ready to retire type of portfolio where there's a large weight of the dollars into the less risky types of investments. And 9 times out of 10, the less risky dollars are almost all contained in bonds.
And if you have target date funds in your 401k, definitely the case.
Bonds and cash alternatives, money markets, things like that, which is super frustrating and interesting because if you were to do just a little bit of research on like, hey, what are like the best bond funds that I should choose from? If you went out to Google and you did that Google search, it would spit back, a bunch of bond funds. I mean, like, hey, here's like, you go to Morningstar. There's an article actually on Morningstar, the top 100 bond funds in whatever, 2024, 2025, whenever you want to see it. They do it all the time. So I actually did that recently because they had bonds and they're like loving them. And I pulled up their portfolio and it just didn't look good. Like the performance was really bad. They were not being compensated for the risk that they were taking. And I knew why. I knew it was because they had a large contingent of bonds in their portfolio. And so I went out to Morningstar and I found that article that's like, here are the top 100 bond funds that you should, do some research on. And I'm like, okay, great. So I pulled some of them actually for our time here on the radio today. I took one from the A's, one from the B's, and then I took a Fidelity and a Vanguard. American Funds Bond Fund, 2.3% 10-year return. The Baird Aggregate Bond Institutional, 2.3% 10-year return. The BlackRock High Yield Bond Fund, 5.94% 10-year return. The Vanguard Total Bond Market Index, it's a huge bond fund that's out there, 1.87%. AG, the biggest bond fund that's out there, 1.87%. This is all 10-year performance. 10-year performance in your bond allocations, that's like abysmal. This is less than inflation rate.
Now, you got to explain quickly what 10-year return means.
10-year return means the return that you would have gotten spread out over that 10-year time frame, like your yearly return, your internal rate of return, how much it grew every single year. So if you started with 10,000 and you ended with 12 or 13,000 over a 10-year time frame, that's like a sub 2% rate of return or so close to it. That's mental math. But it's close to that. This is the per year return.
It is. Okay,
the per year return. So like the Vanguard Total Bond Market Index, this is not to like dogpile on them. I mean, it's a huge fund. Tons of people use it. But its 10-year return Its 10-year performance is 1.87%. And so clients came in, they had a huge allocation into that fund. And I was like, hey, you know what we should do? We should really look at replacing those bonds with an annuity. And they were like, no freaking way. Not going to do it. I'm like, really? Why? Like, because they're expensive. I'm like, oh, well, hold on. You got this huge allocation into this Vanguard bond fund, 1.87%. Did you know that? They're like, did not know that. Thought it was doing better. I'm like, it's not doing better. 1.87%. Okay. I'm not bearer of bad news here. Here it is. Do you see it? Morningstar, 1.87. They're like, oh, wow, that is really bad. I'm like, yes. I'm like, let me show you this zero fee growth annuity. It tracks with the S&P. It's got a 0% floor. You can capture up to 10.25 of the S&P performance on a year-by-year basis with no fees. The downside is it's not fully liquid. But let me just share with you, Mr. and Mrs. Client, the last 10 years returns. 10.25, 1.38, 10.25, 10.25, 0, 10.25, 10.25, 10.25, 0, 10.25, 7.31%, 10-year return. 7.31 with no downside market risk versus your bond fund at 1.87 with downside market risk. So you said you didn't like annuities, so we'll just throw that in the trash. And they're like, hold on, is that real? I'm like, yeah, it is real. And every single person that comes in with a huge bond allocation should look at how those bonds have performed over the last 10 years. Just look. You don't take my word for it. Look up the ticker symbols. See how those bond funds have performed over the last 10 years and compare it to the S&P and look at the S&P's performance. And instead of saying, but I don't want it to be in the S&P, right, compare it to an annuity that has no fee on it, that is tracking the S&P, and then put a 0% on the negatives and put an upper limit cap on the positives. Make the cap whatever you want. Make it 6%, make it 7%, make it 8%. They're as high as like 10.25%. Make it less. I don't care. It's going to crush your bond allocation. It just will. And it has. And people don't know that.
Again, it's our job to bring ideas and education to you. If at the end of that analysis, just black and white facts, if you still say, I love my bonds, I hate annuities, I don't want it, great.
Great.
It's no problem. We can provide bonds for you, but you need to know what's going on.
That's right.
Reach out to the team at retireatlradio.com. Again, retireatlradio.com. Revamp the homepage. You'll see it right in front of you. It says book a meeting. It could be a phone consultation via Zoom or in person. The home office is in Woodstock, but they can meet you across Metro Atlanta at a time and a place that fits your schedule. Again, retireatlradio.com.
Insurance products are offered through the Insurance Business Advanced Planning Group. Vincent Financial Group is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Advanced Planning Group are not subject to investment advisor requirements. Advanced Planning Group and IPW are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be constructed as advice designed to meet the particular needs of an individual situation. Vincent Financial Group is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained by sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Vincent Financial Group. This podcast is a paid placement.